Bill Gates is, of course, one of the richest people in the world. A little bit of a controversial figure these days. Some people love him, some people hate him. That's for you to make your own opinion on. But in the last reported quarter, he sold a ton of different stocks in his portfolio. The Bill and Melinda Gates Foundation, basically their investment firm, sold a ton of different stocks during the market volatility. In fact, sold even some of my personal favorites like Microsoft and Google, which was a huge shock to me because Google is the stock that I've been buying the most of during this market crash. However, there are 10 different stocks in this portfolio that Bill Gates hasn't sold a single share of, even while the market has been plummeting, hasn't sold a single share of these stocks. So in today's video, I'm going to run through every single one of them, give you my thoughts on each one, and let you know if I plan to buy any of these myself as a long-term investment, considering that Gates is still seemingly bullish on them. So it should be a fun one. I hope you guys enjoy it. And let's go ahead and jump straight into this list. Okay, now I'm going to be counting up here from the smallest positions to the largest, and this is for the last reported quarter for, again, the Bill and Melinda Gates Foundation. That was the first quarter of this year. That's the last reported one. And first up here, we've got On Holdings, ticker symbol ONON, at over $12 million, but only worth about 0.06% of the portfolio. And this is primarily a Swiss shoemaker that is famous for their high-performance running shoes, which they've gained a lot of popularity for, especially through famous athletes that have won competitions using their products, like, for example, the 2019 long-distance world champion Javier Gomez, and even the tennis great Roger Federer, who has his own On shoe line and was even an early investor in the company as well. Now, the stock only recently IPO'd last year, and despite it not being around for very long, it has already crashed by over 50% this year and closer to 70% from its highs. It's also despite the company growing their sales by over 70% last year, thanks to the popularity of their brand and the high growth in their online direct-to-consumer store. However, the problem is that losses continue to get worse every year, and right now, the stock market just absolutely hates these type of high-risk speculative stocks that don't generate any profits. The revenue growth is also expected to come back down to around 40% a year going forward, and while that is still very high, it's also significantly lower than before, and it may get even worse if the economy goes into recession. So not a stock that I really feel like picking up at this time. Moving on though to stock number 2, that's going to be Weber, ticker symbol WEBR, which he owns about $25 million worth at just over 0.1% of the portfolio. And if you guys like to barbecue, then you've probably heard of Weber before, because they're world famous for their charcoal, gas, and electric grilling machines. Unfortunately, inflation has been weighing on their input costs, which resulted in their profits declining last year, despite having a large rise in revenue growth. And this year, sales are actually expected to decline by double-digit percentages as the economy struggles to find its footing, which has already caused the stock to crash by close to 60% from its highs after IPOing last year. And yet, despite that crash, the current share price is still higher than the average analyst price target. So I just think that this would be too much of a headache to own right now, and I'll be passing on it myself, even though I do love to barbecue. Moving on though to stock number 3, that's going to be Madison Square Garden, ticker symbol MSGS, which he owns about $50 million of at about 0.25% of his portfolio. And this is of course the company that owns the large sports arena in New York, among other things. But because of the pepperoni lockdowns and restrictions, both their sales and profits have taken a nosedive over the past 2 years. I think the reason why Gates is not selling out of this one, at least not yet, is because this year is a large recovery as the economy opens back up, which should result in their sales skyrocketing by almost 80% expected. After that though, they're expected to return to their typical low single-digit growth, and personally, I just think this will always be a pretty boring business without much innovation or opportunity for growth, which is not only reflected in the volatility of the stock, but has also left it pretty much flat over the past 5 years. Yes, it's down a lot right now, and yes, that might set it up for a large recovery if the economy avoids a recession and starts to recover itself, but I just think that there's much safer and overall better options out there, especially if you're a long-term investor. Moving on though to a very controversial and some would argue a conflict of interest perhaps kind of stock for Bill Gates. Here at number 4, that's going to be Sanderson Farms, ticker symbol SAFM, at half of 1% of the portfolio, worth close to $100 million. And the reason why I say that this one is a bit controversial these days is because we all know that Gates has been buying up a ton of farmland across the country. And the issue is that the pandemic lockdowns and the different policies that Bill Gates has frequently advocated for that ended up really destroying the economy, well, that's led to record inflation, which has caused the average selling price per pound of Sanderson chickens to rise by over 33%, while the feed cost only rose by 14%. And as a result, Sanderson's net income profit skyrocketed from $96 million in the first quarter of 2021 by more than 3 times that amount to over $320 million a year later. In other words, the inflation is actually benefiting this farm, and by proxy, it's also benefiting Bill Gates. Whether that's right or wrong, I'll leave that up to you guys, but meanwhile, the stock has risen ever since and is currently trading near an all-time high, even at a time when the rest of the stock market has been crashing. Personally, though, I'm just not really all that interested in this stock because, number one, it's already climbed by so much. Number two, I just find farms to be a pretty boring business overall that I wouldn't really enjoy keeping track of. And then number three, while their financials are doing extremely well right now, with sales expected to surge by over 30% this year, I do think that inflation will eventually get under control, and that's when I think that their business will return to very low growth once again, as is evident in the negative 3% that is expected next year. So it's going to be another pass for me. On to stock number 5, though, we've got Coupang, ticker symbol CPNG, at just over 0.5% of the portfolio and worth over $100 million. Now, if you've never heard of them, this is actually the e-commerce leader of South Korea at over 20% market share, and it's sometimes considered like a maybe tiny little mini version of Amazon, but of course in South Korea. And that's actually pretty appealing to me. That market is worth close to $100 billion, and Coupang is doing less than $20 billion right now, so there's still some room for growth there. But the issues that I have with them is that they consistently lose money on the bottom line, which is causing the stock to crash, having now lost close to 80% of its value since IPOing last year. And while that may set them up for a good entry point, I'm just not really sure that I want to own another foreign stock that is harder to keep track of just because I don't really use their product myself. And while their sales are growing, it's only expected to climb by around 20% a year, which I just don't really think that that's very high growth for a company that can never really seem to turn a profit. So I just think there's safer options out there with even higher growth, and I'll be passing on this one. On to stock number 6, though, we've got Schrodinger, ticker symbol SDGR, which is the first stock on the list to make up more than 1% of the portfolio, valued at over $200 million. And this is mostly a healthcare and life sciences company that develops chemical simulation software that is used by drug makers to develop their own medicines. And the interesting thing about Schrodinger is that they actually use the software themselves too to either develop their own drugs or even partner with other companies on theirs. Unfortunately, though, they are still not yet profitable, with last year seeing almost as big of a loss in profits as they even made in sales. But this is clearly a longer term play by Gates on the future of biotechnology and drug discovery, which is also evident in their high revenue growth of close to 30% expected this year, but then accelerating to more than 60% expected next year as well. And while the stock has been destroyed over the past year, falling by over 60% during that time, which could be setting it up for a good entry point as a long-term spec stock, I just think that there's much safer biotech stocks out there that are also heavily involved in drug discovery, but that are actually profitable and even pay out some very attractive dividends. So it's going to be another pass for me, as I already own way too many spec stocks in general. But hey, if I was in the market for another spec stock, I would actually give this one a much closer look because I do actually kind of like it at these prices. I think they've got potential. As for stock number 7, though, we've got a much larger and actually profitable company in Coca-Cola FEMSA, ticker symbol KOF, at close to 2% of the portfolio and worth over $300 million. But before you make any assumptions, you should know that this is actually not the main Coca-Cola company itself, which would be ticker symbol KO, but rather this is the Central and South American part of that business that is headquartered in Mexico, and it targets those associated markets. As for me, though, it's just too much of a boring, kind of slow moving stock to ever get me really excited. Because despite having not even crashed with the rest of the market and it's actually trading near a 52-week high, the stock is still down by over 30% in the past 5 years, regardless. Financially, they are very profitable with reliable net income of well above $10 billion dollars a year, but growth is very small, and while I love the dividend of almost 5%, I'm just not sure it's enough to make up for the poor performing stock price. I really think that over the long term, you'll be wishing you had invested your money in a more exciting, more innovative company than leaving it parked in this slow moving stock. All right, guys, that brings us now to stock number 8, though. And for this one, we've got Ecolab, ticker symbol ECL, at closer to 4% of the portfolio and worth close to $800 million. Now, this is actually a pretty popular stock in the market. They're famous for being the market leader in selling sanitation and various cleaning products and services, especially to large businesses and retail stores, which is why you'll probably recognize this Ecolab soap dispenser that is oftentimes found in retail bathrooms. But for that reason, both sales and profits actually declined in 2020 because of the lockdowns where many businesses were closed, and thus Ecolab had fewer customers to sell their products and services to. Since then, though, their business has picked back up and sales are now expected to climb by over 12% this year, and then more typical mid-single digit growth that you would expect from a company like this starting next year. And you know what? I actually really like this company. I think they have a business that is never going to go away, especially with how obsessed everyone has become with sanitation because of the pandemic. And even when their profits were negative in 2020, they still grew their dividend, which has now increased for almost 3 decades in a row, even through recessions and market crashes. I know the yield is small at less than 1.5%, but at least you know that management is dedicated to paying it even through challenging times. Plus, the stock has now crashed to even lower levels than during the 2020 recession and pandemic, despite currently going through a large recovery in their business. Unfortunately, though, the valuation is still super expensive despite that, and that is really the only reason why I've never touched this stock myself. Even after the crash, it is still trading more than 100% more expensive than the rest of the sector. Don't get me wrong, I do think that they deserve a premium, but that's probably pushing it a bit. Okay, we are now down to the final 2 stocks, and coming in at number 9, we've got Canadian National Railway, ticker symbol CNI, at closer to 10% of the portfolio and worth close to $2 billion. And as the name implies, this is one of the largest railroad companies out there with nearly 20,000 miles of network connecting Canada, the US, and Mexico, and reaching all 3 coasts, those being the Pacific, the Atlantic, and the Gulf of Mexico. Personally, I've always found railroad companies, though, to be a bit boring, and I haven't really found myself ever caring about them or wanting to track them or research them, and their financials mostly reflect that kind of boring type of business because they typically have low to mid single digit growth. I wouldn't say that it's a bad stock in the sense that, they are profitable and they even pay a nice little dividend of around 2%, but the stock price itself is still too high for me because even after a recent drop of about 20% from its highs, the valuation is still significantly more expensive than the sector at around a 30 to 50% premium. I don't mind paying a premium for a business that I actually like, but I'm not willing to pay that for a railroad company that I really have no interest in keeping track of. So it's another pass for me. And finally, though, that leaves us now with the 10th and final stock of the day. And for this one, we've got Waste Management, ticker symbol WM, at about 15% of the portfolio and worth close to $3 billion. And this is a very popular, very well-known company as they are the market leader of not just waste management in general, but also by landfill volume management as well. And one of the reasons for that is because they consistently acquire smaller competitors to continuously grow and dominate the market. But even here, they're still only commanding about 1/5 of the market, so there is still room for them to keep growing in the future despite their already massive size. And while 2020 was a dip year because things were locked down and thus there just wasn't as much action and activity in the world to produce more waste, they've quickly recovered from that to reach a new record high in sales and are now expected to return to their typical mid to high single digit growth. Unfortunately, though, the stock is still pretty high even after falling by more than 10% this year, and it is still up by over 100% in the past 5 years, which ends up leaving the dividend still pretty low at less than a 2% yield, despite having been grown for almost 2 decades in a row. I like the company, I like the business, And I think the dividend is still a nice little bonus, even though it's pretty small. But really, the biggest reason why I've never purchased this stock myself is the same reason why I've never purchased Ecolab, and that's the valuation, which is still trading close to 100% more expensive than the sector on certain metrics. Anyway, that does it for today's video. Overall, I would say the same thing that I've basically always said about Bill Gates' stock portfolio. It is full of a bunch of really boring, kind of mediocre companies and stocks. And I know that some people like to make the argument that Bill Gates is more of a value investor and some of his stocks are more stable and recession proof, but I don't even really think that that's the case with the stocks that we ran through in today's video. Maybe a couple here and there, but overall, I just think that these are not great long-term investments, and I think there are much better options out there. In fact, I think Microsoft and Google are great buys right now while the market is plummeting, and yet he's sold out of those stocks. So I just can't really make any sense out of what he's doing here. But those are just my thoughts and feelings. I'd love to hear what you guys have to say down below. Do you agree or disagree with anything I said? Do you like any of these stocks? Or do you agree with me that it's just full of a bunch of kind of boring, mediocre stocks that are not exciting enough to really be investing in long term? But anyway, like I said, I'd love to hear your thoughts. I'll try to respond to as many comments as I can. Thank you so much for watching and for all the support. I'll catch you guys in the next video. Take care. Bye-bye.